Now, before we start the impact, before we go actually into this presentation where we'll see the practical impact on various items of NBFC's balance sheet, we need to check that what are the general items in NBFC's financial statement. What are the impact-prone areas in NBFC's financial statement in liability side as well as asset side. So, if you can see on the screen, on liability side, NBFCs generally have deposits, debentures and other instruments which are there to which must have been used by the NBFC to fund their business, and compound financial instruments, related party borrowings, bank borrowings. These are the general items in case of NBFC's balance sheet which you will find. And on the asset side, you will find investment in equity, debt, other securities, investments held in subsidiary and associates, loans and advances lended, related party loans, employee loans, and derivative instruments. So these are the general liability or asset items which you will find in NBFC's balance sheet. And if you understand this, then no, majority of these are financial assets or financial liability, which are covered by most complex IND AS standards, that is IND AS 32, 109, and 107. So the above areas are covered by the complex IND AS standards, that is financial instrument standards. So before going into the practical aspect, we should first understand what are the provisions of IND AS 32, IND AS 109, and 107. Then we can practically check the applicability of the standards onto each area of these items of the balance sheet. So let us first understand what are the classification and measurement principles laid down in IND AS 109, 32, and then we can go ahead with the discussion about how it will impact the particular item of balance sheet. Of course, we have a slide wherein we will check the practical impact of each item of the balance sheet, which are generally found in the NBFC's balance sheet. So as you can see on the screen, generally IND AS 32 and 109 speaks about the list of these items, which are either financial assets or liability, that is trade receivable, investment in equity and debt securities, cash and cash equivalent, loans, advances, deposits, some derivative transactions, borrowings, other advances, convertible instruments, and trade payables. Till now, NBFCs, if you'll understand, then majority of the NBFCs will be having investment in debt securities, or long-term equity investment they must be having. So, or loans or advances taken or given would be there. So all these items were earlier, say investment were earlier covered by only one accounting standard, that is accounting standard 13. Which used to speak only regarding current and long-term classification, which did not give any kind of measurement principles that you have to measure it at fair value or some else rate. No, it was focusing more on the cost. So majority of the investments in NBFC's balance sheet are still measured at the cost, unless there is a long-term diminution in the value and you are providing for it. Otherwise, all the investment in NBFC's balance sheet are provided at the cost. But now there is a biggest change. Now, IND AS 32 or IND AS 109 requires them to be fair valued or go for amortized cost. So all those things will come into picture, and it will change the each and every figure which are till now measured at cost without any issues. So IND AS, of course, AS 30, 31, and 32, that is financial instrument standards, having similar content like IND AS 32 and 109 were earlier also notified by the MCA, but they were recommendatory. So nobody used to follow it. But now under IND AS, it will become difficult to follow. Also, audit will become, in audit, there would be many challenges in case of such estimates and in case of audit of such items. So let us first see what are the definition of financial instrument, that is financial assets and liability. Then we can check the practical implication of the same. So financial asset is nothing but cash, equity instrument of another entity, that is your equity investment, a contractual right to receive cash or another financial asset from another entity, that is maybe loan. To exchange financial asset or financial liability under potentially favorable condition, derivative contract which are favorable to you as on the date of balance sheet. Financial liability is nothing but a contractual obligation to deliver cash or another financial asset to another entity, that may be loan, repayable, or borrowings. An exchange to exchange contractual obligation to exchange financial asset or liability under potentially unfavorable condition, that is derivative contract which are unfavorable to you as on the date of balance sheet. Also, IND AS did not normally is till now did not speak about the bifurcation of some convertible instruments, some compound instruments, which includes some sort of equity portion and some sort of liability portion. But here IND AS 32 gives that bifurcation in case of some of the instruments. So we have taken some example on the screen. First is preference shares. Preference shares till now were considered as financial liability, or sorry, preference shares till now considered as a equity of the company. Though they have a feature similar to the financial liability, wherein there is a fixed return, you do not have any variable return. So, and some fixed sort of things are there which are similar to the loan kind of thing, but still they are classified as a equity under Indian GAAP. But now after the IND AS 32, which requires you to classify it as a financial liability. So of course your debt equity ratio will change to that extent. So in case of convertible bonds and debenture, till now they were classified entirely as a financial liability. But since you know that it is a convertible bond, so after a few years it may get converted into equity shares. So it has some sort of equity option or some sort of equity in it and some sort of financial liability portion in it. So generally you have to bifurcate this type of loan into equity and financial liability under IND AS scenario. So compound financial instruments, you have to bifurcate that into equity and loan. Again, it will have an impact on your debt equity ratio and other ratios which are related to this item. FCCB, of course, FCCB is a foreign currency convertible bond. It is a carve out under IND AS, wherein it is considered as a compound financial instrument which will again get split into equity and financial liability portion. So any company which is holding FCCB will have to classify it into equity and financial liability, and then they may have to recognize, find out the EIR, that is effective interest rate on the financial liability portion, and they have to recognize that cost based on that. And equity portion will be frozen at that date. So these are the classification in Indian GAAP. These were either equity or either or they were financial liability. None of these were bifurcated into equity and financial liability based on its characteristics. But now IND AS requires you to do this type of things. So this will become a separate challenging task for a company to do this. Of course, it will have a hit on some key ratios also. Now let us see what are the recognition principle or in case of initial recognition as well as subsequent measurement. So IND AS 109, IND AS 32 of course is speaking regarding presentation of financial instrument, that is we saw that equity and debt classification as well as definition of financial assets and liability. And now we are coming on to IND AS 109, which speaks about recognition and measurement principle. So IND AS 109 simply says that initial recognition of financial assets and liability except trade receivable. Initial recognition of financial assets and liability should be done at a fair value, and subsequent measurement of FA and FL is done in FVTPL, FVTOCR, amortized cost, depending upon the solely payment of principal and interest, that is contractual cash flow test and business model test of the entity. Now, what are these two tests which we have to do before classification or before measurement of financial asset in either of these three criteria? That we will check in the next slide. But before that, let us understand that any financial asset or financial liability, except trade receivable, of course, that has to be recognized at a fair value on the date of transaction. You cannot recognize it at a transaction value, you have to recognize it at a fair value, as on the date of transition. So this is the strict requirement by IND AS 109 that on initial recognition, it has to be at fair value. Now what will happen on subsequent measurement? On subsequent measurement, which will be generally on the reporting date, you will classify your financial assets and liability in either of these three categories, that is FVTPL, that is fair value through P&L, FVTOCI, that is fair value through OCI, or amortized cost. Now, how this classification, how this measurement will be done? It will be based on the SPPI test or contractual cash flow test. SPPI test of contractual cash flow and business model test. Now, what are these two terms? SPPI test of contractual cash flow is nothing but the solely whether your contractual cash flow from this financial asset are solely payment of principal or interest, or you gain something else also. And what are your business model of the entity? Business model speaks regarding what you will gain after holding this financial asset or financial liability. What are your intention? Your intention is to hold it till maturity, or your intention is to hold for trade, held it, whether your intention is to hold it for trading. So that is the business model test, and based on these two tests, we will decide which classification our financial asset or liability will fall in. So in the next slide, we will decide that financial instruments. Specifically, this slide is for financial asset. So, what are the classification and measurement criteria in IND AS 109, or how you will classify your financial assets into amortized cost, FVTOCI, or FVTPL? Based on these two tests. Financial assets, of course, will be classified in either amortized cost, FVTOCI, or FVTPL, based on business model and contractual cash flow test. Now, let us take first example of debt investment. So, our checkpoint goes like this. We will first check whether contractual cash flow are solely payment of principal and interest. If yes, then we will further check the business model test. We will further do the business model test. So, say in a debt investment, generally your contractual cash flow are solely payment of principal and interest. So your first test gets satisfied. And then second test is what is your business model after holding this investment. For example, you have investment in a debt. Then at an entity level, what is your business model? Whether you are holding this debt to debenture or whether you are holding this debenture to collect contractual cash flow of principal and interest, or you are holding it just for collecting contractual cash flow, as well as you having intention of selling it. So this too has to be decided at the entity level. So for example, you have a debenture and you are of course satisfying the contractual cash flow test of solely payment of principal and interest, and you are going ahead and checking the business model test, wherein you are wherein you are finding that you are holding this debenture, say bond or say any other debt investment, just to collect a contractual cash flow till its maturity. Then you have to classify it as an amortized cost. And if you are not holding it to collect just contractual cash flow, and you have intention to sell it also in case you find a good amount of price in the market, then you have to either go for FVTOCI or FVTPL option. So if you can see, if your cash flow or contractual cash flow is fixed till maturity, that is you are holding this debt investment till maturity, then you have to go for amortized cost. Otherwise, we will go for a fair valuation, either through OCI or through P&L. In case of equity investment, let us check that. Of course, here also there are two criteria. Whether it is, of course, contractual cash flow test will not get satisfied in case of equity investment, because there are no fixed contractual cash flow in equity investment. So we'll check whether it is held for trading or held till maturity. Say it is held till maturity and not for a trading. Then you have a FVT OCI option. And in case of FVT OCI option, it is an irrevocable option in case of equity, wherein you cannot revoke that option in future and go for a FVT PL. So if you select this FVT OCI option, then of course it will die in OCI. It will not get changed to PNL. So that equity investment has to be changed. That equity investment has to be checked whether it is held for trading or or till maturity. If it is held for trading, then you have a FVTPL option. You do not have any FVTOCI option. Now, what would be the change? I mean, in case of financial asset, if it goes in FVTOCI or it goes in FVTPL, how it will impact? So as I earlier said, OCI items do not have impact on EPS. So whatever goes in OCI, either it may be gain or loss, it will not affect your EPS because your EPS is calculated based on the P&L profit. So here they have mentioned that how you will bifurcate your debt investment and equity investment and how you will measure it subsequently as well as how you will classify it. So, let us go ahead. As we checked in the financial asset, there are three options. In case of financial liability, there are only two options, either amortized cost or FVTPL. If you read the IND AS 109, it says that each financial liability should be classified at, should be measured at amortized cost, except for these three conditions which are mentioned on the screen. And of course, to avoid any accounting mismatch, that is your financial asset is directly linked with the financial liability and financial asset is being measured at FVTPL, then also you will have to measure your corresponding financial liability at FVTPL. Otherwise, residuary head is amortized cost, so majority of the financial liability will be measured at amortized cost. So as you can see, fair valuation is a biggest challenge, seems to be a biggest challenge in case of NBFCs, wherein they will have to fair value its debt as well as equity investment. For equity investment, it is fine if you fair value it and you can find the rate from the market. But debt market is not that much matured in India where you can find this valuation easily. So that will consume some of your time. And in case of equity investment, of course, it is bit simple, wherein you have to be quoted. In case of quoted investment, you can find the price directly on the stock market, and you can value your equity investment at that price. But in case of unquoted investment, of course, you will have to do some valuation exercise. So how this is different from the previous gap? Just saw the classification and measurement principle laid down in IND AS 109 in brief for financial asset as well as financial liability, but how it is different from earlier gap. So as I told you, in earlier gap, there were no financial instrument standards. Of course, there were AS 30, 31 and 32, which were always recommendatory and never mandatory. So only one mandatory standard, AS 13, was there to follow, which used to give some kind of guidance for the investment portion. Of course, it had only classification guidance of current and long-term classification. It did not have any measurement guidance, in deeper measurement guidance. You can say it was saying that you have to value it at a cost. Of course, in case of permanent diminution, you have to value it at a market rate. But generally, the cost was followed in 80-90% of the items of the investment. So it was always cost based and never fair value based. Now you can see in the second row there is a further classification of FVT OCI, FVT PL, or amortized cost. So these three type of classification are there. Effects was affecting only PNL. Now based on your choices, it may affect PNL or OCI. So your EPS is now at your option. I mean, based on your business model test and of course SPPI test. Long-term investments were carried at a cost. Here, of course, there are three options. No guidance was there on expected credit loss of financial asset. Now there is an extensive guidance on expected credit loss model, which we will see in further slides. There are no separate guidance for, there were no separate guidance for equity debt classification. Now just we saw before few slides that how we have to bifurcate the some compound instruments into equity and financial liability. So there is a detailed guidance on it in IND AS 32 presentations of financial instruments. This is how the earlier gap was pretty simple, where you have to just you are just focusing on the cost. You are just valuing your financial instrument at a transaction value rather than at FVTOCI, FVTPR or such amortized cost type of classifications or measurement. So that was pretty much simple, but now of course you will have to do this kind of exercise wherein you will bifurcate your financial instruments into different categories, and then you will classify and